Right now, before you have filed a single document this year, the income tax department already knows things about your money that you haven't told them. That's not a threat, that's just how the system works today. 10 years ago, that sentence would have sounded paranoid. Today, it's the norm. There was a time when hiding financial information was actually possible. Today, it has become dramatically more difficult, not because tax officers suddenly became smarter, but because data did. Let me ask you something. How many people actually know how much salary do you earn? Probably your employer, your bank, maybe your family. Here's the part most people never think about. The income tax department probably knows more about your financial life than you imagine. Not because someone is watching you, not because someone is reading your bank statement at night, but because every financial transaction leaves behind a digital footprint. Every salary credit, every TDS deduction, every bank interest, every mutual fund redemption, every property purchase, and every dividend. Any significant transaction creates information, and information travels. Most taxpayers still believe one thing: if I don't tell the department, they won't know. That belief may have been closer to realities years ago. Today, it has become a very expensive assumption. Here's the sentence I want you to remember for the rest of this video. The income tax department doesn't investigate first, it compares first. And that single sentence explains why dishonest taxpayers sometimes receive notices, why small omissions become big issue, and why taxation in India is no longer just about filing a return. It's about whether your financial story matches the data that already exists with the department. So today, I'm not going to teach you sections of the income tax. I'm going to take you behind the scenes and show you how India's tax intelligence system actually works, how information reaches the department, how it gets connected, and how technology compares it. Because once you understand this system, you'll stop looking at taxation as paperwork and start looking at it as data. Here's something fascinating: the system wasn't always like this. Go back 15-20 years. The department didn't have a connected digital ecosystem at all. Your employer knew your salary, your bank knew your interest, your broker knew your investments, the registrar knew your property purchases, but each one of them held only one chapter of your financial story. Nobody had the complete book. You could guess the picture, but you could never be certain. Then something changed. India didn't just become more digital, it became more connected. Banks, employers, stock exchanges, mutual fund companies, property registrars, one by one, each started reporting through structured system. Today, technology does something that was almost impossible earlier. It connects those pieces, not to invade your privacy, but to check whether the story in your return matches what's already been reported through legal channels. And this is where most taxpayers get it backwards. People assume the department read their return first, then goes hunting for information. The reality is opposite. The information already exists, your return is simply held up against it. Data is connected, data is compared, differences get flagged for review. Understanding today's system is no longer optional. Taxation isn't driven by paperwork anymore, it's driven by data. So, the obvious question: where does all this information come from? Does someone sit and collect it manually? Well, not at all. Think of India's financial system like a city. Every institution keeps a small record of what passes through it. A bank knows the interest it credits, your employer knows the salary it pays, a broker knows what you buy and sell, a registrar knows when property changes hands. Under law, many of these institutions are required to report that transaction. Let's start with a term you have probably heard: AIS, Annual Information Statement. Don't think of AIS as just another text document. Think of it as financial mirror. It pulls together what's been reported about you into one place. Important. AIS is a statement, not a proof. Third party data can contain errors, which is exactly why reviewing it before filing matters. Then there's Form 26AS. Many assume it's the same as AIS. It isn't. 26AS is traditionally your tax credit statement. TDS, TCS, tax related entries. AIS is much broader. Don't think of them as competitors. Think of them as two chapters of the same story. Now, TDS. When your employer or bank deducts tax at source, that deduction doesn't stay a secret between you and them. It gets reported. Same story with the mutual fund redemptions and certain property transactions. The data flows through prescribed reporting channels. No single institution knows your complete financial life, but each contributes one page. And gradually, those pages become a very clear picture. One more term worth knowing: SFT, Statement of Financial Transactions. You don't need to memorize the abbreviation, just remember the concept. Certain high value transactions get reported by law, not because you're suspected of anything, but to improve transparency. Let me make this real. Neha earns a salary, keeps money in fixed deposits, invests through SIPs, buys a flat. None of it is unusual, but each institution involved reports its own piece through its own system. When Neha files her return, she is expected to make sure her disclosures match all of it, because the system isn't looking at isolated transactions anymore. It's looking at her complete financial story. So how does technology actually connects all these different pieces together? That's next. Does someone sit in an office opening file after file, comparing thousands of transactions by hand? 20 years ago, that would have been almost impossible. Today, technology assists in organizing, comparing, and flagging differences across huge volumes of reported data. Think about Google Maps: millions of vehicles moving at once, and within seconds, the app spots congestion and reroutes you. Not because a person is watching every road, because technology is processing enormous amounts of data. Modern tax administration works in a broadly similar way. Large volumes of reported information gets compared electronically, not to prove guilt, but to flag what you may need a closer look. Let me show you exactly how this plays out with an example. Let's say Raj earns 18 lakh rupees a year. He has one fixed deposit, two SIPs, some dividend income, and he redeemed a few mutual fund units during the year. Everything is completely legitimate. He reports his salary carefully, claims his deductions, verifies his TDS, files his return. Sounds perfect. Except for one small thing. He forgets to include rupees 8,000 of interest from an old fixed deposit. For Raj, it's an innocent slip. For the system comparing reported data, it's simply a difference. The system doesn't know if Raj forgot, or the bank misreported, or something else explains it. It only sees that two pieces of information didn't align. This is why I keep repeating one sentence. The income tax department doesn't investigate, it compares first. Comparison is not accusation. A mismatch is not finding a fraud. Most differences come from timing issues, reporting errors, genuine omissions, things that just need clarification. The better your financial story matches what's already reported, the smoother your compliance journey. Which raises the real question: if the system is this intelligent, Why do honest people still get notices? The answer is surprisingly simple. Taxation isn't about numbers, it's about human behavior. And human beings are wonderfully predictable. Most tax mistakes don't happen because people don't know the law. They happen because how we think. Here are 5 traps I see that cost most people. Trap number 5, the memory trap. Quick question. What happened on the 14th of August last year? Most of us wouldn't remember. Yet every year, millions of people try to reconstruct 12 months of financial activity from memory. One forgotten FD, one dividend, one interest credit, not because they meant to hide it, but because memory was asked to do a document's job. Memory is for conversations, documents are for compliance. Trap number 4, the assumption trap. This might be the most expensive sentence in taxation. I think TDS already took care of it. Tax law doesn't run on assumptions, it runs on facts. Trap number 3, the last minute trap. Every July, thousands of returns get prepared in a rush. When you're rushing, your brain stops verifying it. It starts finishing. People don't get careless because they lack knowledge. They get careless because they are racing a deadline. Trap number 2, the overconfidence trap. I have been filing returns for 10 years. That's exactly why many people stop checking. Experience builds confidence, sometimes too much of it. The moment you stop reviewing, you start assuming. And trap number 1, the biggest one, the trust trap. Many taxpayers trust memory. Some trust software. Some trust their consultant completely. But very few actually trust the documents. The best tax professional don't rely on memory. They rely on evidence. Because documents don't forget, people do. And that's the biggest lesson from the whole video. Tax returns rarely fail because people don't know enough. They fail because people assume too much. Good tax compliance isn't about having a better memory. It's about having a better process. Review, compare, verify, then file. Build that habit, and technology stops being your enemy. It becomes your friend. We have covered a lot: data, AIS, TDS, banks reporting systems. At this point, you might feel like taxation has become frightening. That's not the takeaway I want you to leave with. In fact, it's the opposite. Modern taxation isn't becoming more complicated, it's becoming more transparent. And transparency should never frighten an honest taxpayer. Picture two people. The first keep proper records, review their information, files carefully, verifies facts before submitting. The second rely on memory, assumption, and last minute filing. Now ask yourself, which one sleeps peacefully after filing? Exactly. The difference isn't intelligence. The difference is process. Good tax compliance isn't about fearing the income tax department. It's about respecting your own financial information. Organized records make reporting easier. Easier reporting builds confidence. And when confidence replaces fear, taxation stops feeling like a burden. It's just another professional responsibility. So before you file your next return, don't just ask, how much tax do I have to pay? Ask a better question. Does my financial story make sense? Because that's ultimately what modern taxation is trying to understand. Not isolated transactions, the complete story. If this changed the way you think about your tax return, do one thing for me. Comment the word AIS below, and I'll personally reply with a 3-minute check I run before filing any return. I am Arun, a chartered accountant. Every week, I break down taxation, compliance, and India's changing financial landscape, not by creating fear, but by creating understanding. If that's the kind of content you value, subscribe. The more you understand the system, the more confidently you can work within it. Thank you for watching. I'll see you in the next one.